The big news of the day, Jon, is Arm filing for its IPO. And while I won't ask you about Arm specifically, I just wonder how much of a starting gun this is going to be for the tech IPO market broadly.
Well, we hope with there have been a few successful IPOs recently, and I think it's slowly starting to open back up. That said, I'm not convinced yet that this is the start of the rush. I think these are trickles, and we'll see how things move. I mean, I think the economy is still very uneven. I think investors are still very uneven, both on the retail side and within the private side. So fingers crossed that it goes well, and that will encourage more IPOs. But I still think it'll be a volatile time for tech for the short, medium term.
And of course, Arm itself, very much B2B, Jon. You've got a lot of expertise in the B2C space. And interesting, I was speaking with the CEO of Macy's just a little bit earlier, how much concern there is, lack of clarity on a consumer in the US right now. How are your consumer tech-enabled businesses doing in this environment?
So I think you have to divide them. We saw, obviously, a lot of froth around sort of traditional consumer type companies using tech enablement. They went public, they got hammered. They weren't really probably public ready companies, even though they were funded like they were. I think real consumer tech is still always a massive opportunity because tech is constantly changing consumer behavior. I think we see that in AI. I mean, look at the explosion of usage of the average everyday consumer with ChatGPT and OpenAI and Bard and so on. And I think we're at the very beginning of that. And that's what's really exciting about investing in consumer tech, because tech is always changing, consumer behavior is always evolving, creating new opportunities in new markets. You know, for example, sorry, go ahead.
Well, it's interesting. I was speaking, of course, with other key VCs in the space, some who know an awful lot around the consumer as well. And when we're talking to companies around AI, they're worried that there's froth at the moment in particular, and valuations have got too heady. Are you feeling the same at the moment?
Absolutely agree with that. If we look back in history, you know, Google wasn't the first search engine. It wasn't the second search engine. It was like the 10th, 11th, or 12th. And we were at the very, very beginning of the first inning with AI. And so trying to anoint winners and kingmakers is very challenging because we have no idea if those will be the companies that get it right in the next 3, 5, 10 years of where consumers are truly using it and what the commercialization is. So there are a lot of baby AI companies that are getting enormous valuations. And I think in the last year and a half, overall in tech, valuations have been deeply compressed. But where they're inflated is around AI. And so there's just a lot more uncertainty. And I think VC funds are going after them like they're sure things, which they're not. We're still very early. Very exciting, revolutionary opportunity, but we're early to pick the winners.
Jon, Torch Capital was in the headlines earlier this year. The Information reported you'd raised about $200 million for a second fund. What's the status of that fund? Have you been shopping yet with any of the funds raised?
Yeah, I think, you know, last year we did very few deals. I mean, Torch, part of our thesis and how we operate is to be very focused and disciplined, which I think we did pretty well over the last 2 years in the froth around the whole tech arena. But right now we are seeing valuations come down, especially in early stage. We're seeing a lot of very smart, focused founders. This is not a fun time to start and build a company and try to raise funds for that. And so you're seeing very determined founders or experienced founders. And with valuations down, we're seeing, and technology again changing, we're seeing a lot of interesting opportunities. For example, one of our portfolio companies called Durable, an area that we're investing a lot behind is the rise of the solopreneur and small business owners. It's the fastest growing part of the US economy. And they actually use AI, but they're basically helping founders get from 0 to 1 to start a business. And part of that is their website. And they can build a website in under 30 seconds that's customized and can take payments and really get a business up and running. And in their first 6 months, they built 4 million websites and helped 4 million businesses get off the ground. And so we're starting to see flashes of where the next generation of companies are going to come from. And so we've actually done 3 times as amount of deals that we did last year already in the first half of this year. So we're very active in the space.
You know, a data point we've been talking a lot about on the show is that in the first half of this year, 50% or more of all of the VC dollars going to an AI startup went to one in San Francisco. You talked about where the next generation in the world you operate is coming from. Is there any clear geographical divide in where you're investing and where new companies are being started?
I think I'd frame the question differently. I think it's all over. I think this company's based in Vancouver. We actually invested in another very exciting company in Vancouver. We're seeing companies all over the country. It's not completely focused on San Francisco and New York. And I think between COVID and the ability to get talent and the commonality of remote work, amazing startups have been built all over the country, which I think is very exciting. And also, there's not just a pure concentration as there used to be. So we're looking everywhere, and we're very excited about a number of regions.
And Jon, just to bring this sort of full circle, we started by discussing ARM and whether the IPO pipeline might be able to, well, start to flesh out a bit. But exits more broadly, are they just on ice? Are you seeing that big companies are willing to start to make a bit of M&A as an exit choice?
They're on ice. I think there has been a valuation reset. We are not near the bottom. I think growth companies and pre-IPO companies are much better at cutting costs and extending runway, so they haven't really hit the open market with new raises. We've seen some, like Stripe and some others, some of the biggest ones, but the true reset hasn't happened, and I think both growth funds and M&A strategics are all just sort of waiting on the sidelines and saying, not until we know we're hitting the bottom are we going to start deploying capital. So I think we have a little bit to ways to wait. I think it'll be toward the end of this year and early next year that we'll see where true valuations sit, and then I think M&A is going to be explosive. It may not always be pretty for some of the valuations we saw in 21, but I think it's going to be a minute before we see a full-fledged M&A back to market.